Well, good afternoon, options traders. Welcome to TradeStation. My name is Don Prattle. I'm the Director of Trader Development and Education here at TradeStation. And today it gives me great pleasure to welcome an old friend from OptionsAnimal.com, one of the top options educators in the industry. Our focus, the focus over at OptionsAnimal is to help people reach their investing goals, whether it's capital preservation, wealth creation, or simply taking control of their own lives through financial security. That sounds a lot like what we are trying to do here at TradeStation, so we're very happy that our presenter, Horace Taft, is with us today. You know, Horace wasn't always an options trader. He wasn't always a trader. He came into the industry after he tried some other things. He currently resides in Western Massachusetts on a small farm. And when he's not engaged with the markets, he can usually be found fishing in the Deerfield River if weather is permitting. He became a full-time trader after he and his wife had owned and operated a retail bookstore and a coffee shop in Minnesota for 15 years. And prior to that, he worked in politics. And as a graduate student, he studied and he taught at the University of Minnesota, making him a proud Golden Gopher. Teaching is a great source of satisfaction, and you're going to find that out today throughout this presentation. So Horace Taft is with us today to talk about the best put strategies for options traders. Our presentation is for educational purposes only. All the symbols, all the trading ideas, and everything we discuss are for demonstration purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind anywhere. Where a TradeStation affiliate is not authorized to do business, including but not limited to Hong Kong and Japan. Active trading is not suitable for everyone, and options trading carries a high degree of risk and may not be suitable for all traders. I've included in the chat panel two pieces of very important disclosure information regarding the characteristics and risks of standardized options, as well as other asset classes that we trade here at TradeStation. I urge you to take a look at that information when you have time. Certainly not during the presentation today. Our question that usually comes up at this point is, are you recording? And yes, we are recording. This presentation will be available in the TradeStation University site sometime tomorrow. We also will have it posted to the TradeStation YouTube page. And if you are a TradeStation customer, it will be available in TradeStation today on your trading platform. So let me turn things over to Horace Taft right now. This is a very good time to be talking about put trading, so I won't waste any of his time. Thanks very much for coming to TradeStation, and thank you, Horace Taft, for spending time with us today.
Thanks very much, Don. I really appreciate it. I've only done this a couple of times on the station, but it's always great to get a new audience, trying to communicate some of my understanding of how to use options. In this case, often to hedge ourselves, to protect ourselves. Certainly a useful tool during the last 4, 5, 6 weeks. We're going to be talking about the best put strategies today, and really this is a bit of a misnomer in my opinion. I don't know what the best strategies for you are, and one of the things I really like about options and teaching options is that you can use the options instruments that we're going to cover today to essentially adjust your risk, right? We are all different. We all have different risk profiles. We all have different portfolio sizes, and likely we have different investing goals. I'm older than many of you, and my goal is to preserve my wealth so that I don't have to work for the rest of my life. So I like some of these put strategies because they allow me to sleep at night. I know that I'm hedged, and on days like today, my portfolio is pretty much unscathed, right? So best put strategy, I don't know. It's going to depend on what your goals are and what your trading style is. And as you do more and more of this, you're going to discover that there are trades you like and trades that don't make sense to you. And that's fine. And at OptionsAnimal, what we try and do is give you the skills so that you can develop your own trading plan and your own trading style to suit your goals and objectives and let you sleep at night. That's a lot of what we're going to be talking about tonight. I need to let you know that all rights are copyright and reserved by OptionsAnimal. And just to reiterate, the content in this presentation should not be considered as a recommendation to buy or sell a security. All information is intended for educational purposes only and in no way should be considered investment advice. Options involve risk and they are not suitable for all investors. All rights and obligations of options instruments should be fully understood by individual investors before entering any trade. So with that said, let's get into this presentation. We're going to talk about a series of different types of applications of puts today. In the OA curriculum, in our paid school, each of these particular trades is a course unto itself. So what I'm going to give you today is a very brief outline of several different put strategies that you can apply either to generate income, protect wealth, or even take ownership of stock in some cases. So we're going to first cover simply buying puts. Most people come to options, their first experience is a directional trade. They're optimistic about the outlook of a company, they buy calls. They think a company's or the stock is going to depreciate in value, they buy puts, right? So we'll cover the mechanics of simply buying puts. Second trade we're going to talk about called a married put. It's when we join a long put position with an existing equity position as an attempt to hedge in times of volatility, such as we're experiencing today. Next trade we're going to talk about is a bull put, way to structure two options, so a spread trade, generally to try and define our risk and generate some income. And then we'll talk about bear puts, more of a directional trade, something looking for chance to make some money as an equity declines in value. And then finally, we'll cover very briefly calendars and diagonals, really flexible spread trades that allow you to express virtually any opinion you might have about where an equity is heading. Options are remarkably flexible, and if you have done your due diligence, formed an expectation about where an equity is going, there's a spread trade out there that matches that expectation. And at OptionsAnimal, we teach you how to use the tools in an option chain to structure those trades in such a way that when inevitably you're wrong about the direction of a stock, you can fix the trade. You're not locked into one outcome as the only way to make money. And then at the end, we have a Black Friday sale. We are a fee-for-service school. There's tuition, but we have some really nice discounts available to you today if you choose to take advantage of it. So let's talk about just buying puts, often referred to as simply long puts. When we buy options, we're long a put or long a call. And the mechanics of this are pretty straightforward. We buy to open an option contract, right? So I will buy to open a put at a specific strike expiring on a specific day. When I'm done with that contract, I sell to close. When I purchase options, I'm essentially purchasing rights. And in the case of puts, I'm purchasing the right to exercise the option and sell the underlying, the stock on which the contract is written, or the ETF, at the strike price I have chosen, okay? That right lasts for the length of the option contract, right up until what's referred to as the expiration of that contract. I also have the right to resell that option, or sell to close, when I'm done with it. I could choose to simply allow the option to expire, but in general, that's not an outcome that you want to see. If the option expires out of the money, it will expire worthless. And if it expires in the money, and in the case of puts, that means if my strike is above where the equity is trading on options expiration, the rights associated with that contract will be automatically exercised, my stock will be sold. I think we crossed this out because you don't actually resell the option, you sell to close the contract. So if I buy a strike 175 Apple put expiring in December, and I'm done with it, I'm not going to go sell a new contract. I'm going to sell to close the existing contract. It's really just semantics. My expectation when I buy a put is that the equity is going to decrease in value. I want to lock in the right to sell something, say Apple at 175, Because I think I know if Apple declines in value, the value of that right associated with my strike 175 put will increase. And I will be able to sell to close that contract for a larger credit than the debit I paid when I entered that. So I have an expectation of bearish movement when I simply buy a long put. I'm looking for that bearish trend. Not hard to find in our markets today. Here's a profit and loss graph, a risk profile of a standard long put. You can see two lines. The thicker line represents the profit and loss at expiration. The thinner line, the curved one, represents the profit and loss of the position on the day I'm looking at the chart. So you can see, first of all, that my risk is defined, right? All I can lose is the debit that I pay. Potential reward extends considerably to the upper left and is limited only by how low the stock can go. We'll get to that in a moment. So my basic application, so let me just stop. There's a lot of vocabulary with options trading. It's really not that complicated, but they like to throw terms around. So we talk about basic application at the money or slightly out of the money. So what does that mean? We talk about an option being at the money when the strike price of that option is about where the equity is trading today. We talk about out of the money, in the case of puts, as being slightly below where the equity is trading today. That's the basic application of a long put. You're not constrained to those limitations, but it's kind of the first step when we talk about buying puts. We say that time value is desired. So what does this mean? Well, options are wasting instruments. The rights associated with my put contract will decay in value day after day after day if the equity doesn't move. As my option begins to come to expiration, the value of that contract diminishes, as the likelihood of the stock moving also diminishes. There's just less time. So what I'd like to do is buy a put with enough time value in it that I won't suffer a great deal as a result of the passage of time should the equity simply stay still. And one of the characteristics of options are, although they all decay in value as time passes, it's not linear. The farther out in time you reach for your options contract, the slower, the more gradual the time decay. As an option approaches expiration, say in the last 30 to 45 days of the contract's life, that rate of decay picks up. That's an important thing to keep in mind when we look at other types of trades, calendars and diagonals, for example. But when you're simply buying a put, if I buy a put that expires a week from Friday, I need that stock to fall right away, right? Otherwise, that option is going to lose value as time passes. So in the basic application, we say time value is desired. Think maybe at least 3 months, because time decay works against this directional long put trade. So our basic requirement is at least 45 days, sometimes even longer. Does a couple of things. It cuts down on the decay as associated with the passage of time, and it gives you more flexibility. You always have to have an idea of what's going to happen when you place a trade, obviously. In the case of a long put, you think the stock is going to fall. We teach our students at OptionsAnimal, not only do they need to plan for what goes right, you need to plan for what might go wrong. And what you will find is that by giving yourself more time at the outset, you're also giving yourself more flexibility. So if you get a stagnant trend, there are adjustments you can make to that long put position to profit in that trend. If the equity actually turns bullish, you have time and flexibility enough to adjust your trade to take advantage of the trend that's actually occurring rather than the one you forecasted. This is considered a debit trade, and that's because the rights associated with the put contract I'm buying are going to cost me something. So I'm going to pay for the right to sell the equity at the strike price I choose. That's where the debit comes in. That debit represents the maximum risk. So down here on this chart, you you can basically see that my risk is defined at this flat red line. That represents the full debit I paid. If I bought the put, forgot about it, the equity trended higher, my losses are fixed. Now the reward on a long put position is easy to calculate. You take the strike of the put that you choose and you subtract from that the debit that you pay. Despite some of the charts I've been looking at, equities can only go to zero. So if I have the right to sell something for $75, I pay $3 for that right, the equity goes to zero, my max profit is fixed at $72. It's not likely, but it happens. So basic point, you can define your risk, you can define your reward with these trades. Now your exit points are entirely up to you. We talk about two different exit points. First of all is our primary exit. When are you going to get out of the trade? So perhaps you're going to define that as a % net gain. So what does that mean? I buy this put contract, the equity on which the contract is written declines in value, and as a result of that decline, my put appreciates in price. So perhaps my primary exit is to sell to close that long put position when I've made, you pick a number, 20, 25%, 50%. Days like today, if you went home last night with long puts expiring on the SPY, 36% profit at the open. Close the trade, look for another opportunity. That's the easy part. The secondary exit is more complicated. So here we have a bearish trade, and you need to be prepared for two things. First of all, a stagnant trend where the equity refuses to move. And secondly, a bullish trend where the equity actually goes in the opposite direction you anticipated. And you need to plan these exits prior to placing the initial trade. This is at the heart of what we teach at OptionsAnimals. And what you will find is that going through that process of planning your secondary exits will make you rethink the initial trade. And if you discover that the secondary exits are not appealing or practical, you may change the initial trade to give you that additional flexibility for those times when we get the direction wrong, which is often in our markets. You can always close these trades at a loss. Just set a percentage loss at which you're not willing to sit in the trade any longer. In general, that's always better than staying in a losing trade hoping it turns around, but it's not a particularly appealing exit. What you want to learn is how to adjust this to a spread trade, and we're going to talk about some in a moment, that take advantage of the trend the market is actually giving you. So here's an example. We have a stock trading somewhere between 85 and 87.50. We have a bearish outlook. So I'll go at the money. In this case, there's 69 days until expiration. So that meets my 45-day criteria. And I'll go ahead and buy to open a strike 85 long put. And I'm going to pay $10.50. So I've bought the right to sell this stock for $85. That right lasts for 69 days. There's my profit and loss graph. And I can calculate the maximum reward by taking the long put strike, subtracting from that the debit I pay, and seeing if this stock goes to zero, I'm going to make $74.50 on this contract. Now I don't need it to go to zero. I'm going to make money as long as we end up at this point or below. So the strike price minus the debit that I pay for the put. Maximum return, 709%. Not likely, but there are stocks out there like Sears and JCPenney. You know, it does happen. Primary exit, however, I'm not going to hold on until the stock goes out of business. I might choose to exit when I can get 20% more for selling to close my contract than the debit I paid when I entered it. And you can see this line, the curved line, you'll enter the trade on this day, right where it crosses from red to green, and if the equity begins to move, your profits will begin to accrue immediately, right? So you don't have to wait till expiration. In fact, hopefully you're not doing that. You'll be able to hit your 20% a lot sooner. So in this case, I would sell when the bid price of the option is $12.60 or higher. Okay. Secondary exit. So here we have a bearish trade. I might choose, and again, this is up to you, to close this at a 50% loss, not an exit I advocate, or convert this to a spread trade. So keep that in mind when we talk about calendars and bull puts, okay? Next example, what's called a protective put or a married put. Really useful, I think, in markets like this. It involves two parts. First is a long equity position. So I own a stock or ETF, and I add to that position a long put, giving me the right to sell that stock at the strike price I choose. They're called protective puts or married puts. They can optimize a bullish, stagnant, or slightly bearish trend. The long equity instrument, the stock, is where you're hoping to make the bulk of your profits. You buy a stock because you think it's going to appreciate in value, but maybe you're a little unsure, and you're going to add a long put to that position to hedge yourself. You always hear people say, I wish I could buy Google at 1,000, or I wish I could buy Apple at 170. And then when you get moves in our markets like today, all of a sudden, what looked attractive 6 weeks ago really gives you pause. And while you'd like to buy the stock, you might not be willing to simply put that risk on the table. See another day down 500 points. You want to hedge yourself. This is the idea with the married put. That long put is there to limit your loss. This essentially is an insurance strategy to protect investments during volatile times so that you can stay involved in a stock and not worry quite so much about the kind of declines we've seen in our market over the last 6 weeks. In general, you might look to put puts on in two specific occasions. During times of increased volatility, such as we're experiencing today, but also associated with fundamental events. Remember that equities, especially this last earnings season, 4 times a year, corporations come out with their earnings for the prior quarter, give forecasts for the future. Take a look at some charts, and you will certainly see that the market can punish stocks severely for misses or weak guidance, and an earnings event represents the possibility of steep declines in a stock, particularly in stocks with high PE multiples. Stocks predicated, whose value is predicated on continuing growth. If that growth slows even a little, you can get outsized moves to the downside. Having a put in place over an earnings event lets you sit through that event without exposing yourself to the same kind of risk you would if you were simply long the stock. You can also add these when you get technical sell signals. Stocks don't go up forever. They reach a zenith, and then you generally see technical indicators, and we teach technical analysis as part of the due diligence at OptionsAnimal. That would indicate that people are going to start taking profits, and you could expect the stock to decline in value. Now, maybe your cost basis in the stock is really good. You've held it for a long time. You don't want to sell, exposing yourself to potential gains and taxes. You want to stay involved with the stock because your long-term outlook is bullish. But you see that, in all likelihood, the stock is going to retrace a little bit of its gains. So you buy a put, right? At the money. Lock in those profits and protect yourself as the equity declines in value. Eventually, it'll find a base, and you can exit those put positions, let it start appreciating again. And this is a question we get. In a bearish trend, when do you close the long put? So this is a lesson that took me a long time to learn. I own a stock. I buy a put because there's an earnings event coming, and the equity, sure enough, falls 15% because of something said on a conference call. You come in the next morning, you turn on your screens, your equity is down, your long put has made a vast amount of money in a percentage terms. The equity falls, that put really begins to accrue value, and it's very, very tempting to go ahead and sell that put because it's up 50, 60, 70%. Don't do that, in my opinion, because the initial reason you bought that put is to protect that equity position. So in a bearish trend, I'm going to close that long put when the equity technically finds bottom, so maybe wait 3 days, make sure there aren't more sellers out there waiting to get rid of that stock. As the equity falls, your put becomes a better and better hedge. And if you really get a steep move to the downside, it's going to be a perfect hedge, or very close to one. So for every dollar your stock goes down, your put will appreciate in value by that dollar. So it's an expensive lesson to learn. I teach my students, stay in those puts as long as possible. Make sure your equity has found bottom, and then you can think about selling the puts. And of course, when you sell the puts, you're going to take a lot of profit in that put contract, and that's going to effectively reduce the cost basis of your stock. And then you can just let it do its thing and recover in price, trade it accordingly. Okay, so what if the equity moves higher? The earnings event comes, actually they said everything right, stock starts to move up. Well, again, remember why you bought the put. It was there to protect your stock. So if the stock is appreciating in value, your overall position will be making money. And you can potentially simply close that put. It'll still have some residual value, and let the stock continue on its way. You no longer need the put. Or you can break that put off, treat it as its own thing, and structure a spread trade to take advantage of the new trend in the stock, the upward trend in the stock. When we talk about bull puts in a little bit, that's an example of one of these potential adjustments for the long put. But how you manage it is entirely up to you. The important thing is that you have that plan written down in place and that you follow it after the event. What you don't want to do in this example is let that put expire. And there are a couple of reasons for this. First of all, if the long put expires out of the money, so the equity trends higher, your long put strike is below where the equity is trading on options expiration, it'll simply expire worthless, and you'll lose the entire debit that you paid for that put. Not an outcome worth doing. You might as well get what you can out of it. And if it expires in the money, so the equity falls in price, your put will be automatically exercised. Your stock will be sold. And remember, the premise of this structure of this trade is that you want to stay involved in the long stock. So in general, if you want to keep ownership, expiration is coming, you can sell to close that put contract. And if you feel it's necessary, open another. Open a new put at a new strike price farther out in time if you think there's potential for the stock to continue to fall. Okay, let's talk about, so those are on the one hand a directional application of a put, on the other hand application that is intended to protect an equity position. Bull puts are somewhat different. They can be used to generate income with relatively limited risk. Again, not requiring often a whole lot from the underlying stock. So this trade optimizes a bullish or stagnant trend, and it involves two parts. A short put, so we're going to sell at the bid, slides are a little funky, and a long put at a lower strike. Now when I sell a put, I take on the obligation to buy the stock at the strike price I've chosen. Remember, when I buy a put, I'm buying the right to sell it at a particular strike. So when we structure a bull put, the basic structure is pretty simple. My short put is where my income, where my money is going to be made, and my long put is there to limit my loss. So in this example, we have a stock trading somewhere between $100 and $185 a share. I'm going to sell to open a strike 180 short put. I'm going to take in a credit of $7.85. And I'm obliged to buy the shares for 180 bucks if the equity declines below that value on options expiration. I'm going to cover my risk. I'm going to hedge myself by buying a long put at a strike below my short. So in this example, I'm buying the 175, and I'm going to pay $5.95 for that. Now, because my short put is at a higher value, the credit I receive for selling that contract exceeds the debit I pay for the long put. The net result of these two trades, or these two instruments, is a credit. That represents my maximum potential reward. My risk is also defined, and it's calculated by taking the difference in strike prices and subtracting from that the credit. So if I'm obliged to buy something for 180, I have the right to sell it for 175. It goes to zero. That represents $5 of risk. But I got this credit when I placed the trade, and that credit's going to offset my risk. Clear? The defined risk, defined reward. Again, I'm going to have a clear idea of what my primary and secondary exits are. If the equity simply stays at $185 a share, day after day after day, both these put contracts will decrease in value as a result of the time decay that we talked about. And you will find that after a period of time, you can close the entire structure, buy to close your short put, sell to close your long put, for a debit that is less than the credit you received. So perhaps your primary exit is to close the trade when you've realized 50%, 30%, you pick it, of the potential profit in the trade. So close the trade early to capture profits. If the equity actually begins to move bullishly and trend higher away from that short put at 180, you may be comfortable staying in the trade right up to options expiration, letting them both expire worthless. What you're left with is the credit you received when you entered the position. In order to do that, both your options need to be out of the money, so the equity has to be trading above your short put strike price on options expiration. And what you'll find as you get more familiar with options trading is that as you approach the end of an options life, small changes in the underlying, small changes in the stock trading value can greatly impact your trades. They tend to get, if your short put is near where the equity is trading, very sensitive to small movements. So it often makes a lot of sense to exit these trades 10 days, 2 weeks prior to the options expiration and go look for another opportunity. You know, you don't want to see a winning trade turn into a losing trade. So here we have something looking for a bullish to stagnant trend. What am I going to do if I get that bearish trend and the equity begins to decrease in value? Here you really have a lot of options. You can plan to honor the obligation that came along with selling that short put. So maybe you do your due diligence. You think this is an equity trading at $185 that's undervalued. I would like to own it. I put on a bull put. If the equity begins to trend below my short put strike, I'm comfortable taking assignment of the shares. Now, obviously, you have to have the cash in your account, and you have to be comfortable with the equity ownership that's going to come when those shares are assigned to you. That's a valid secondary exit if you plan for it. And we'll talk a little bit more about something called a collar trade. Just give you a real brief example of how you could manage that kind of trade. You can also close this trade early to minimize a loss, right? Or adjust this to another spread trade. Now, there are lots of adjustments available to bull puts. So I'm going to talk about just one of them, and that's a collar trade. It involves equity ownership. So I put this bull put on. The equity begins to trend lower. Nothing fundamental has changed. I'm comfortable with the valuation at 180. But I've become convinced at some point, yep, I'm going to get assigned. And I'm going to prepare for that assignment. By definition, I have a stock that's trending lower in price. My long put should be making money. So I'm going to go ahead and close that long put position. And I'm going to open a new long put farther out in time, possibly at the 180 strike, so that when I'm assigned shares, I have a long put in place because my stock is falling in price. Okay? Once I'm assigned the shares, I'll come in. I'll likely reach even farther out in time, sell a short call to offset the cost of that put. And I'm going to be in what's known as a collar trade. Long stock, long put, short call. Collar trades are infinitely flexible. You can structure them so that even when you own an equity, you can be profiting as the equity falls in value. So there are lots and lots of ways to structure a collar trade, and at OptionsAnimal, it's really the fundamental trade for people who own stock, using a collar trade to hedge ourselves when the equity is falling, take those instruments off during bullish times, and dynamically manage your trade through the vicissitudes of a price chart, basically. A couple other notes about this. There are other ways to adjust bull puts. One of the things people like to try and do, as the equity begins to decline, we become skeptical that this 180 is going to sell or going to expire in the money. I might try to do something called rolling the trade. So I might buy to close this bull put, go farther out in time, lower down in strike, open a new bull put, ideally for a credit, give the equity more room to the downside. I guess I'm getting a little ahead of ourselves, but that's a really attractive strategy. What you'll find, though, when you go through the exercise is you generally need to either widen the spread of that new bull put trade, therefore increasing your risk, or add contracts to it, also increasing your risk. When you go through that exercise, it may impact, if that's the chosen secondary exit you have, the strikes of the initial trade or the number of contracts in the initial trade. But it's going to give you a lot more flexibility. And again, all this adjustment process, the entire level in our options animal curriculum. And we go through it in pretty exhaustive detail. All right, so let's talk about bear puts. Bear put is a trade that optimizes a bearish trend. I'm looking for a declining stock, but I'm going to hedge myself a little bit. So here's our example. I have a long put, strike 35. I'm going to buy that for $1.80. And I'm going to then sell to open a strike 30 put, taking a credit of 55 cents. So the primary exit, or the primary instrument in this trade is that long put. But whereas with a simple long put, a directional trade, I need the equity to move pretty extremely to the downside. This one limits it. I'm selling that strike 30, I'm taking in a credit. That's going to reduce the debit that I'm paying for that long put. And it's going to essentially hedge me. It'll cap my gains, but it's going to reduce my cost as well. So the short put is really there to lower your cost basis. I can calculate the maximum reward by taking the difference in strikes and subtracting from that the net debit. So again, I have the right to sell this stock for $35. I have the obligation to buy it for $30. That represents a maximum profit of $5, but I'm paying for that. So I'm going to subtract that debit from the width, okay? Now this also is a debit trade, and the maximum risk I face is the debit I pay when I buy the spread. Again, primary exit, close the trade at a predetermined return on investment. Secondary exit, I might choose to close the trade early for partial profits. I might close it early to minimize losses, or I might adjust this to another spread. So given what we've covered, here's a directional trade. Well, actually, you know, we'll get to it in a moment. Simple application, bear put. All right, so everything we've talked about now, we've talked about long puts, which are simply directional long puts, married puts associated with an existing equity position, bull puts, which involve two puts in the same options expiration series, bear puts the same thing. Now we're going to break these trades up, and we're going to introduce an element of time in an attempt to express an opinion, maybe stagnant trends, slightly bearish trends, and try and make money on the different rates of decay in the options that we're buying and selling. So here we have a put calendar. In general, these are going to be structured as slightly bearish to stagnant trades. Two parts to it. First of all, the long put, and and then a short put. The long put is considered my primary instrument in the standard application of this trade. I'm going to make money in my long put as the equity gradually decreases in value. My short put is there again to reduce my cost and essentially hedge my risk. You can actually structure these, whereas in a long put, straight up long put, you need negative movement in your stock. These can actually be structured in ways to make money if the stock does nothing. We'll walk through that example in a moment. So here's a profit and loss graph, the standard kind of witch's hat. There's a misconception about trading options that you have to be absolutely precise about where a stock is going to be on a specific day. That's not the case. But looking at this graph, you can see that the bulk of your profits, the main profit, is going to be right here at this apex. But I'm still going to be profitable anywhere between, say, $30, $38. Let's walk through how this trade works. We're combining an out-of-the-money, long-term long put with at least 3 months or more until its expiration. And I'm combining that with a near-term short put at the same strike price in a much closer options expiration. Again, my maximum risk is defined as the debit I pay to enter this trade. Despite there being at the same price point, because I'm buying a long put contract with more time in it, I'm going to pay up. I'm going to pay more for that contract than the credit I will receive for selling that near-term option. So my maximum risk is the debit I pay when I enter the trade. And the maximum potential reward exists right at the apex of this profit and loss graph. So imagine, if you will, that the equity falls in value, expires just above your short put. Your long put has increased in value as a result of the falling stock. Your short put expires worthless. That's where the maximum profit exists. It's not necessary, but that's the absolute best case scenario. We talk about maximum potential reward when managed for a single expiration period. Now, your profit and loss graph only shows you profit and loss up to the first expiration series. But if my stock declines in value, because I went so far out in time with my long put, my short put expires worthless, I have the option to sell another put, take in additional credit, and further enhance potential rewards. That's what we mean by managed for a single option expiration series. If you manage it over a long period of time, maximum reward is, anyway, theoretically unlimited. You can continue to short against your long put position. When your long put comes close to expiration, roll it out, buy a new one farther out in time. Just keep running the trade. A couple of things about put calendars. Generally, you don't want, in the standard application of these trades, really fast movement to the downside. I'm not sure we have the slides in here, but what you want is more of a gradual decline. You want the value to bleed out of that short put that you sold as the equity slowly moves lower. And there are plenty of candidates for these kinds of trades. Stocks off the top of my head that might not be candidates are things that tend to move dramatically. Think about high growth, think of Netflix, Salesforce, stocks that are prone to gappy movement, sudden changes in price. Those aren't necessarily candidates for this type of trade. I'm looking for boring stocks, Coca-Cola, General Mills, things that move gradually. So let's talk about diagonals. Whereas in a calendar trade, the strikes of the options are the same, and the only difference is in the expiration periods of your long and short. In diagonals, we're going to move that short to a lower strike, usually. They're going to involve, again, two instruments, a bearish instrument in your long put and a short put on its own bullish, there to take in a credit, limit your loss, offset the cost of your long put. So again, we're going to go at least 3 months out in time for that long. We're going to sell a near-dated short put at a different strike price. Ideally, what I'm looking for is a stock with a visible level of support. My expectation is that the stock will trend lower and that that support will hold. Doesn't have to, but that would be the best case. And I can sell my short put just below that support level, so that that short put expires worthless, the stock has declined in value, my long put is appreciated, I'm done. Move on to the next trade. Maximum potential reward is also at the short put strike, just as in a calendar. And again, if you continually sell short puts against your long put position, you have the opportunity to greatly enhance your returns, theoretically unlimited returns. So this is the same type of profit and loss graph. It's just skewed a little bit to the downside. And there's some important differences, right? Let me walk through some of them. So because my short put is at a lower strike in this example, I'm giving the equity more room to the downside to move before that short put becomes violated, right? So this trade is going to be more sensitive to downward movement in the stock price. If, for example, with Apple trading at 176 today, I do a put calendar at 170, so I sell a short put at 170, I buy a long put at 170. I want Apple to decline right to that short put. If I'm slightly more bearish, for example, I might do buy the 175 put, sell the 170. And what that does is change the nature of the trade. I'm giving Apple another $5 to the downside before my short put becomes a problem. The trade-off for that is my calendar trade, well, my diagonal trade will be slightly more expensive because the premium I'm getting for selling this lower strike put will be less. So I'm taking on more risk. And in exchange for that risk, I'm giving the equity more room to the downside. Okay? What you'll find with calendars and diagonals will teach you how to do something called calculating a net position delta, which simply tells us how the trade is going to behave as an equity moves $1 in price. All right? The idea with this is that in a put diagonal, I'm going to have a higher negative delta at the outset. In a put calendar, I might be delta neutral, close to it, maybe slightly bearish. And as the equity trends lower, the delta in both these trades will begin to change. So you have to be cognizant in these trades. I'll show you where it happens on this chart. If I enter the trade right here, hang on a second. There's actually a fair bit of information. This is the day I enter it. Now we have two lines. This curved line represents the profit and loss graph today. The thicker blue line represents the profit and loss graph at options expiration. That second line isn't going to move. As time passes, these lines will converge, right? So if nothing changes, this gray line will gradually begin to rise until it's coincident with the expiration. So I can tell you at this point, this line is going to be moving up. And I'm in a theta positive trade. I'm in a trade that's going to make money every day if nothing changes, simply by the passage of time. If the equity should begin to rise in price, let's get rid of some of this, beyond, say, this level, so this price, this gray line now becomes, it goes to the outside. And as these two lines converge, that gray line is going to be moving down. So at this point right here, I'm in a theta negative trade. That's not the idea with these diagonals and calendars. And learning how to calculate the net position Greeks gives you really good indications of when it is you might want to evaluate adjusting your trade, right? Let's go back to the put calendar. It's even clearer, I think. Bear with me. So again, here, this portion of my profit and loss graph is going to rise with the passage of time. I'm in a theta positive trade. If the equity gets beyond this bound or beyond this bound, I'm now in a theta negative trade. The premise of a calendar trade is I'm going to take advantage of the different rates of time decay. I'm going to be in a theta positive trade. So there are lots of markers along the way that tell you this trade's done. You need to adjust it. You need to move your short put. You've now gone theta negative. And you can see, you know, $30 to $39, there are bounds to when these trades will work. If you get too much movement, your trade can go from a theta negative put diagonal to a theta positive trade. Prior to allowing that happen, you're going to close your trade, probably at a profit. You don't want sudden moves in price to alter the dynamics of these trades. If all this sounds confusing, it probably is at first. But we go through it very, very painstakingly at OptionsAnimal. The premise of our company is to give you the maximum education that you can absorb so that you can structure trades that make sense for you and learn how to manage them going forward. I don't know of a more rigorous education. I know TradeStation makes resources available and that they're to be applauded for that. Trading is a funny thing. It's one of the only vocations that you can enter with basically no barrier to entry. The market in general doesn't care if we know what we're doing. All you need is a funded account and access to a trading platform. Market's happy to let you do your best. It's not going to go well. If you're going to do this seriously, if you're going to try and trade for a living or to enhance your income or to protect your savings, you really owe it to yourself to get the most education that you can. I firmly believe that no one can manage my money better than me because no one cares more than me. I've had paid financial advisors. They're okay with 2008. They'd rather it didn't happen, but it's not their money, right? As I get older, I realize I can't live through that type of a drawdown and hope to retire when I want to retire. I need access to put strategies like the married put, the long puts, to protect myself when the market goes haywire like it's going now. I still suffer, I still lose, I don't make money every day, but I know that my losses are fixed and I can sleep at night because I have puts in place. And I'm confident that the shares in Apple I own will one day be worth $230 again. So I'm not going to sell them. I bought puts weeks ago. And you get into these strange dynamics where you put all these hedges on, you're long the stock, and you're actually hoping it goes down because you understand or you think that the market's acting relatively irrationally in some ways. And it'll recover. Things always do. And eventually, you know, value will return to the positions I hold. And in the meantime, my puts are there protecting me, generating income, et cetera, et cetera. So don't know what I'd do without it. If you're simply buying and selling stocks, you're dependent on the movement of an equity in order to generate returns. With options, you can structure trades such as calendars that can make money if nothing happens. You know, one of the things we never talked about today or didn't talk about today is volatility, especially with puts. As the market begins to melt down and people begin to panic, implied volatility comes into the options pricings in a very meaningful way. And I think the best example is when you buy a long put and the stock begins to plunge, people generally reach for that protection. They pay up for options pricing. And very often the benefits of rising volatility can match or even outweigh what you get from price appreciation or depreciation in a long put contract. So there are lots of opportunities out here. When we see stocks like Apple today, you know, trading at 175, the implied volatility is near a 52-week high. If you're comfortable owning this stock, the premiums available to you for a bull put are pretty substantial right now. The more premium you take in that trade, the less risk you face. And if you're okay following through and buying the stock, there are lots of ways to structure bull puts. Generate some income if Apple simply stays down here, or if it begins to rise. Gives you a lot of flexibility. That's about what I've got. I need to let you know, one thing I do want to let you know, we do have a sale going on. I got to get through these. Well, I'll read this because they love this. You know, the best time to plant a tree was 20 years ago. The second best time is now. So I'm 57 years old. I started trading on my own shortly after the 2008 crisis, when a money manager I had really didn't have any response to that crisis. And I figured, okay, fine, I can learn how to do this. Started using options, and I very quickly realized I needed to know more about the risks and potential rewards. And that's when I found OptionsAnimals. Right? I wish I had done this 27 years ago or 30 years ago. But that's the general gist of this one. It's never too early or too late to start this. But if you're going to do it seriously, please get the education from someone. I think we're the best company, but get yourself educated so that you know what you're doing. Before I turn it back over to Don, you know, we have a Black Friday sale just like everyone else. If you can call us in the next 30 minutes, we can lock in 1/3 off your membership. There's a free consultation to make sure you know how to get the most out of your OptionsAnimal membership. And if you can join us by Friday, the 23rd of November, we're throwing in this service called the weekly trades. I'll tell you a little bit about that before I end the webinar. Once a week, one of our instructors, and there are 5 of us, this week it was my trade. We go ahead and we go through the 6-step process that we teach. We do our due diligence. We form an opinion about where an equity is going. We evaluate potential structures for the trade along with their primary and secondary exits. We go ahead and execute that trade with our own money, and then we share all this work with subscribers to this service. And whenever we make an adjustment, we post it. You can watch essentially over our shoulders as we manage the trades based on the OptionsAnimal method and the curriculum that we teach. That's what this weekly trade is. What you're going to find when you come to OA, 90% of these trades close for profit, right? And it's not because we get the direction right. It's because we teach how to structure trades that can be fixed when we're wrong. Everybody's wrong. So my trade today was a put calendar actually on XLP. We'll see. I'll manage it, but I'm confident in the end that trade will be profitable. There are 2 numbers at the bottom of the screen. Give them a call. We have various different membership levels, and they can walk you through the various choices you might have. And with that, I think I'm going to turn it back over. Don, are you still here?
Are you kidding? But thank you again, Horace, for your time this afternoon. And thanks, everybody, for spending time with TradeStation today at this excellent webinar.